Hey everyone, welcome back to your channel. Imagine your brokerage account lighting up with cash every single month. Not quarterly, not yearly. 12 reliable deposits a year. Money for rent, groceries, bills, or reinvesting without touching your principal. Sounds like the ultimate passive income dream, right? Monthly dividend ETFs aren't a cheat code to effortless wealth. They're powerful cash flow tools for U.S. investors, but only if you know exactly what you're buying, where the income comes from, and the hidden trade-offs that can hurt your portfolio long-term. In this video, we're diving deep into the top monthly dividend ETFs. We'll cover how each ETF really works under the hood, current yields, holdings, expense ratios, and performance, who each one is perfect for, and who should avoid it. Real risks in today's market: interest rates, volatility, taxes. Tax implications specific to U.S. investors. A practical portfolio example with expected cash flow. Common mistakes that kill returns. This isn't hype. It's straight talk for Americans building real retirement income or side cash flow in 2026's environment. With Fed rates stabilizing, inflation cooling but still a threat, and markets volatile from tech concentration and geopolitics. Monthly dividends do not mean guaranteed income forever, risk-free cash, automatically higher total returns, no chance of principal loss. All monthly refers to is the distribution frequency, how often the ETF bundles and pays out income. Most U.S. stocks pay quarterly. Many bonds and REITs can pay monthly. Some ETFs use options or other strategies to smooth it out. But where is this monthly money actually coming from? There are three primary sources. Stock dividends from profitable companies. These can be qualified, tax-advantaged at 0 to 20% long-term capital gains rates, or non-qualified. Bond interest from government, corporate, or mortgage-backed securities, usually taxed as ordinary income, up to 37%. Option premiums from covered call strategies. These are typically taxed as ordinary income. They boost yield in flat or down markets, but cap upside in big rallies. Misunderstanding this leads to disappointment. Some ETFs mix them. High yields often come from options or riskier assets, and sometimes include return of capital, ROC, which isn't true income. ROC lowers your cost basis and can create a bigger tax bill when you sell. Monthly income prioritizes cash flow and psychological comfort over maximum total return or growth. If your goal is aggressive growth, say you're under 50 and decades from retirement, these might not be ideal as core holdings. If you're retired, nearing retirement, or want supplemental income without selling shares in a downturn, they shine. Now, let's break down the key ETFs. I'll start with one that doesn't pay monthly because it's foundational. 1. SCHD. Schwab U.S. Dividend Equity ETF. Quarterly payer, but essential foundation. SCHD tracks the Dow Jones U.S. Dividend 100 Index. High-quality U.S. companies with strong balance sheets, consistent profitability, and long histories of dividend growth. Expense ratio, just 0.06%. Massive AUM. Over $76 billion, super liquid and cheap. Top holdings include Coca-Cola, Pepsi, Home Depot, Broadcom, Lockheed Martin, Texas Instruments. Real businesses generating cash from operations, not financial tricks. Current yield, around 3.6 to 3.8%. Pays quarterly, but the dividends are high quality and tend to grow over time. Dividend growth focus. Why include it in a monthly income video? Because chasing pure monthly payers often means sacrificing quality and growth. SCHD has outperformed many high-yield ETFs in bear markets, held up well in 2022, and provides stability. Many investors use it as the core and layer monthly payers on top for smoother cash flow. Pros: sustainable income, lower volatility than broad market, strong total return over decades, tax-efficient qualified dividends. Cons: quarterly payouts. You can manually smooth by timing buys. Lower yield than covered call ETFs. Perfect for long-term investors wanting dividend growth plus stability. Pair with monthlies for hybrid income. 2. JEPI. JP Morgan Equity Premium Income ETF. Monthly. This is the most hyped monthly payer, and for good reason. Launched in 2020, it's actively managed. Owns a diversified basket of large-cap U.S. stocks, S&P 500-like, quality bias, and sells out-of-the-money covered call options on them to generate premium income. Distributes monthly. Current yield: around 8.0 to 8.25%. Varies with volatility, higher in choppy markets. Expense ratio: 0.35%. Huge AUM, very popular. How it works: equity sleeve provides some growth and dividends. Options add extra income, often 6 to 10% annualized premium. In sideways or mildly down markets, it shines. In massive bull runs, like much of 2023 to 2025 tech rally, it lags the S&P 500 because calls get exercised and upside is capped. Who it's for: retirees or near retirees wanting steady monthly cash without selling shares. Income-focused investors comfortable trading some growth for stability. Who it's not for: young investors prioritizing maximum capital appreciation, growth chasers. Risks: opportunity cost in strong bulls, ordinary income taxation on much of the distribution, active management risk, though JPM's track record is solid. Historical note: performed well in 2022 downturn relative to pure equities. 3. JEPQ. JP Morgan Nasdaq Equity Premium Income ETF. Monthly. JEPI's more aggressive sibling. Same covered call strategy, but on Nasdaq 100 stocks. Heavier tech exposure: Apple, Microsoft, Nvidia, Amazon, etc. Expense ratio: 0.35%. Yield often higher, 10 to 11.5% plus, depending on volatility. Higher potential income, but higher volatility and bigger drawdowns during tech corrections. 2022 hurt more than JEPI. Think of JEPI as a reliable sedan, JEPQ as a sports car. Exciting income but bumpier ride. Use in moderation, 10 to 20% of portfolio max. 4. QYLD. Global X Nasdaq 100 Covered Call ETF. Monthly. Popular alternative. Another covered call favorite on Nasdaq 100. Sells at the money calls monthly. Yield historically high, around 11 to 12% recently. Expense ratio higher, 0.60%. Pros: very high monthly income. Cons: significant upside cap. Long-term total returns have lagged QQQ dramatically because it rarely participates in big rallies. Higher fees. More income at the expense of growth. Great in moderation or sideways markets, but many experts warn against over-allocating. It's income-focused, not total return. 5. Bond ETFs. AGG. iShares Core U.S. Aggregate Bond ETF, or BND. Vanguard Total Bond Market ETF. Monthly distributions. These hold thousands of U.S. investment-grade bonds, treasuries, corporates, mortgage-backed securities. Expense ratios ultra-low, 0.03%. AUM enormous. AGG approximately 130 billion plus. Current 30-day SEC yield approximately 4.1 to 4.2%. Monthly payouts from interest. Why essential? They lower overall portfolio volatility, provide ballast in stock crashes, 2020 recovery helped, and offer predictable income. In 2026, with rates potentially stable or declining, bonds look attractive again after 2022's rate hike pain. Risks. Interest rate risk. Prices fall when rates rise, duration approximately 6 years. Credit risk. Minimal in AGG. Inflation erosion if yields don't keep up. Who for? Conservative investors, retirees seeking stability. Core of 60/40 portfolios. 6. Realty Income O. The Monthly Dividend Company, or REIT ETFs like VNQ for diversification. Realty Income pays monthly dividends, legendary consistency, raised for decades. Yield, around 5.2 to 5.3%. Focuses on single-tenant, net lease commercial properties, Walmart, Dollar General, Walgreens, recession-resistant tenants. REITs must distribute 90% plus of taxable income by law, hence reliable payouts. Pros: monthly cash, diversification beyond stocks/bonds, inflation hedge, rents often escalate. Cons: sensitive to interest rates. Higher rates increase borrowing costs, hurt property values. Sector risks: retail/office shifts post-pandemic. VNQ, Vanguard REIT ETF, yields approximately 3.8 to 4%, but pays quarterly. Good for broad exposure. Use 5 to 15% for real estate income without buying physical property. Building a realistic monthly income portfolio, U.S. investor example. Sample conservative allocation for a $500,000 portfolio. Adjust for your size/risk. 30% SCHD to stability plus growth, approximately 3.7% yield contribution. 25% JEPI to steady monthly core income, approximately 8% yield. 15% JEPQ or QYLD to higher income boost, approximately 10 to 11%. 20% AGG/BND Aero safety plus monthly bond income, approximately 4.2%. 10% O or REIT exposure Aero diversification plus monthly, approximately 5.3%. Blended yield target, 5.5 to 7% range, Aero, $2,300 to $2,900 per month gross before taxes/fees. Rebalance annually. Use tax-advantaged accounts, IRA, Roth IRA, 401k where possible. Intaxable. Favor qualified dividends where you can. Deep dive. Risks nobody talks about. Capped upside/volatility drag. Covered calls limit gains. Interest rate risk. Bonds and REITs suffer when rates spike. Tax drag. Much monthly income. Options premiums, bond interest, REIT, taxed as ordinary income. Qualified dividends from SCHD are better. Return of capital. High-yield ETFs sometimes return principal, erodes NAV long-term. Inflation. 5% yield loses purchasing power if inflation greater than 5%. Sustainability. Yields fluctuate. 2022 showed cuts or NAV drops possible. U.S. tax considerations, critical for Americans. Qualified dividends, SCHD, some equity. 0%, 15%, or 20% plus 3.8% NIIT for high earners. Non-qualified/ordinary income. Most covered call premiums, bond interest, REIT distributions. Up to 37%. REITs. Often mix of ordinary income plus ROC. Tax-deferred but reduces basis to higher cap gains later. ETFs are tax-efficient. In-kind redemptions minimize cap gains distributions. Strategy. Hold high-tax distributions in IRAs. Use taxable for qualified dividend ETFs. Consider municipal bond ETFs, tax-free, if in high bracket. State taxes vary. Check your state. Track via 1099-DIV. Harvest losses if needed. Common mistakes to avoid. Chasing highest yield without understanding source/risk. Over-allocating to covered calls. Growth starvation. Ignoring total return. A 10% yielder that loses 20% NAV isn't winning. No diversification across sources. All options equals bad in low vol. Selling in panic during drawdowns. Forgetting fees/taxes eat into net income. How to get started as a U.S. investor. Open/use low-cost broker. Fidelity, Vanguard, Schwab, Robinhood. Fractional shares great for small investors. Start small. Dollar cost average monthly. Enable DRIP, reinvest if growing, or take cash for income. Monitor. Yield, distribution history, ETF.com, Morningstar, official sites, NAV trends. Tools. Portfolio visualizer for backtesting, broker screeners. Minimums. Most ETFs have none or very low. Final thoughts. Monthly dividend ETFs aren't magic, but used wisely. With realistic expectations, diversification, and understanding risks/taxes, they deliver real cash flow, stability, and peace of mind. This is how disciplined U.S. investors build sustainable income, not how gamblers chase yields. Focus on total return plus cash flow needs. Don't put everything in high-yield monthlies. If this helped clarify monthly dividends for your situation, smash that like button, subscribe for more no BS breakdowns, and comment below. Do you need income now or growth first? Which ETF are you most interested in? Drop your questions. I'll reply. Thanks for watching. Stay smart with your money. See you in the next one.